welcome you here to the second of the SCORE series. This series is intended to help people who are thinking about getting into business or who are in business but fairly new to business and didn't know all the things they needed to know. Today's topic is all about resource partners. We have two here of the type that you'd want. We usually tell people you want to have a lawyer, an accountant, and an insurance agent. So at this time, what I'm going to do is turn it over to John, and as I said, we'll take questions afterwards, so to hold your questions till after they're done with their portion. All right, John?
Okay, good. Thanks, Louise. What I'm going to do, as Louise indicated, is I'm going to go through a series of questions. A lot of them are questions that I get when people first come in to meet with me. I'll admit some of them I've worded in a way that I'm kind of lobbing it out there so I can fill in some gaps for you as to things that you might want to pursue a little bit further when you talk to somebody. The general idea, though, is that at the end of the day, this is going to, I think it'll be hard for you guys, almost as hard as it's going to be for us, that when I go through and list the questions, I need you to kind of make your notation that you want to come back to that if you want to have me fill in a little bit more information on it. Because the goal is to leave enough time after we go through these different topics that you'll have an opportunity to ask all your questions then. In any case, the first question I have up there is asking about what qualifications should I look for in an accountant. And really what I'm suggesting here is that when you go to find an accountant, probably one of the first things you want to do is talk to other business owners, talk to bankers, talk to attorneys, but check around a little bit to see what their qualifications are and see if somebody else has worked with them. The key thing that I always tell people as far as working with a professional is it's a relationship. You want to feel comfortable talking to them. You want to feel that you've got basically a sense of they know what your business is, so you're comfortable to contact them whenever the need may arise. The issue really is, and I think David will probably focus on a little bit too, is that it may not be a case where you're sitting there thinking, well, I have all this list of questions that I need to talk to my accountant about today or to talk about with my attorney, but when the question comes up, you want to have that established relationship so you know who you're going to call and who you're going to ask questions of. The next one about how do you find a good bookkeeper. This one's actually kind of an interesting one, and we'll talk about it a little bit later as far as in some cases I'm seeing more and more business owners doing their own books or at least attempting to. There's a lot of software out there, and I'll talk about some of the software later on. But the issue here that I'm bringing up is you may find, if you're comfortable, you'll do a lot of your own initial bookkeeping, and I wouldn't discourage you from doing so if you're at all inclined that way, just because I find that's what makes you better about monitoring how your finances are doing. In other words, if you immediately turn over all of your accounting to a bookkeeper, a third-party bookkeeper, it's a little bit harder for you to get that comfort grasp as far as what the numbers mean, how to read the numbers, that kind of thing. All of that said, you will find that a bookkeeper takes away from you one area of the business that most people really don't enjoy doing. Which probably sounds funny coming out of an accountant that makes a living doing those kinds of things, but that's kind of the reality of it. I always talk about the idea that if you have the opportunity to go out and generate more sales for your business versus sitting home doing your accounting, which one of the two are you going to do? Perhaps I should say which one of the two should you be doing, but my point being that bookkeeping tends to get pushed off to the side. With that in mind, though, you don't ever want to let it get so far behind that it's a huge burden to get caught up. If you find that you're going to try and do it on your own, you're not successful doing it on your own, then you want to find a bookkeeper. And similar to the accounting situation, in order to find a bookkeeper, you really need to check around. The other truism on bookkeepers, and by any chance is anybody in here looking to get into bookkeeping? Is that an area that I was going to say it's an area in high demand. I find quite frequently that I'll have a bookkeeper that's doing the accounting for 2 or 3 businesses. They're busy. They're filled up at that point. So when I call them and ask about, if they can take another customer, they really can't. So it's one of those areas that, in some cases, I'll have a list of bookkeepers that I could refer to you, but quite often they get busy, they fall off the list, and then I've got to find somebody else to fill in. And again, we'll come back to some of the computerized accounting, and I'll pull that in a little bit more. As far as reviewing your books and being able to determine if your bookkeeper is doing a good job, this one I put in there a little bit with the idea that even if you do engage a bookkeeper, you want to make sure that you're reviewing your books. And that's why I was saying before that if you're at all comfortable with the finances, you should at least get so you're comfortable enough to look at them and determine whether you feel that they're being maintained the way they should be. So some of the things that we recommend, for example, is if you have a bookkeeper, that you always review the bank reconciliation, that you check through to make sure that everything looks like checks that you would have written or for an expense that you would have incurred for the business. Just that kind of activity keeps you more closely involved with the books, and it avoids the issue of fraud by your bookkeeper. And I always hate bringing that topic up, but it's also one of those topics that needs to be presented. So that's where I want to make sure that if you've got a bookkeeper maintaining your books for you, that you're following up to check in on it. And you should be anyway. All right, what is cash basis versus accrual basis accounting, and how do I pick one? I don't want to get too complicated on this one, but basically what it amounts to is that most people run their business on a day-to-day basis as far as how they monitor how they're doing. They'll do it quite often on what I call a cash basis, which means it's based on cash in other words, whatever money that's come in the door that you've deposited versus cash out, any expenses that you've actually paid. So that's your idea of a cash basis. That's the very simple way of maintaining a business's books. What I would tell you, though, that is for most businesses as they start to grow, and in part depending on what the business does, you want to move more toward an accrual basis of accounting. And what accrual does is it recognizes income when you earn it and when the expense is incurred. So the logic being, to give a quick example, you do services for a business, you bill that business for those services performed. On a cash basis, you don't report that income until it actually comes in the door. So that may be a month or 2 or 3 months down the road, as opposed to on an accrual basis, you record that income the month that you actually performed the services or sold the product. So I'm trying to distinguish between the timing of when you report the income. It just makes it a little bit cleaner using the accrual method to report it during the period that it most applies to. All right? And I'm going to leave it at that. I know I've got some blank stares out there, but the idea is we want to go through all these. If you want to come back to it, let me know. But like I said, most people start their businesses on a cash basis. How can I have a profit but no cash? I get this question all the time. This is one of those, again, where you get into the situation of, especially if you're using the accrual method of accounting, you've got those items that you've billed for, which have been recorded as income now, but you've not received the cash yet. So on your income statement, it's going to look like you've got a profit just because you've reported that income already based on when you performed the work or sold the service or the product, but no cash has come in the door yet. So you've got a scenario where your books are showing income, but you've got no cash in the account to reflect those services performed or the product sold. All right, and again, we'll come back to that later if people have questions on it. Those are topics that are a little bit hard to go over without actually seeing the financial statements for you to get a better grasp on it. But I did want to present it just because that question comes up a lot. You're going to find that as you get into business, you're going to think, boy, I'm doing great, I've got all these services, I've got all these sales going on, but unless it's truly on a cash basis, you have that mismatch that's going to occur. What are the components of a balance sheet? What do they mean? I bring this up in part because I think people get a little bit too hung up on all the components of the financial statements. There are those items that belong on a balance sheet, and the idea of the balance sheet is basically it's reflecting those items that basically as of that day could be measured. For example, what you've got in your checking account that day, what you own for equipment. On the other side, what you've got for loans that are outstanding. So they're all numbers that you can verify. That's the idea of the balance sheet. The thing that people get hung up on is you'll hear accountants and financial people talk about the idea of what's a current asset, what's a long-term asset, what's retained earnings, what are equity. So you get kind of hung up on some of the terminology involved. And it's not to mean that there isn't some significance to all that terminology, but it's not quite as critical as I think it sounds like. I don't want you to get hung up on, you're not booking something to your financials because you're not sure whether it should be a current asset or a long-term asset or whatever category it may fit into. So that's really the reason that I wanted to bring up that question though. All right, do I need to prepare a budget? I'm a big advocate of preparing a budget because that's kind of that opportunity where you have to go through all of the assumptions that make up basically how your company makes money. In other words, you have to determine how much you're going to bill for your services, how much you're going to bill for the products that you sell. You have to determine what the related expenses are for those items or those services, what other operating expenses that you're going to incur. And it's a good exercise to make sure you go through and pick up all those different pieces of it. This again is one of those areas where it's probably helpful to have a relationship with an accountant so you can compare notes with the accountant as far as what you put together for your budget. That said, you'll also find, and I can do the sales pitch for SCORE and SBDC, that they also do a nice job of working with folks with putting together the budget. So like I said, it really helps you as far as learning and getting more comfortable with all the relationships as far as the income and expenses for your business. It's also a case that you're going to find that when you go to talk to a banker, that you're going to need to have a budget in place, in essence, to present to them. And when I talk about a budget, you also hear people talk about their projected income statements. You'll hear them, in other words, they'll use different terms. They'll talk about a forecast, but it's all pretty much the same thing. You're sitting down, putting together the numbers as to how your businesses are going to operate and make money in the future. And obviously, one of the goals when you're going through and doing a budget is to make sure that at the end of the day, you actually have some net income to show for your efforts, which is why I was saying you kind of work backwards to a certain extent to determine what you need to charge for your services or for the products that you're selling. I keep waiting for a question, I have to admit.
Now, we're trying to hold those. They should be writing down the questions on the pads they have.
Okay, like I said, what is a profit and loss statement, and does it differ from an income statement? No, it's terminology, and that's kind of what I wanted to make clear, is that you'll hear people refer to things with different terms. Quite often, we use the acronym, the P&L. What's your P&L showing? Well, that's the profit and loss, but they're all the same thing. Where it does differ a little bit, and we'll talk about it, I kind of touch on it in the next question of what expenses are included in cost of goods sold. Much like I was saying with the balance sheet, there's groupings that pertain on your income statement that, again, I don't really want people to get hung up on that. And by grouping, what I mean is that you'll see people go through and on the income statement, you might see them group, for example, all of their insurances together. So they've got all kind of the related expenses in one grouping. And if that's the way you think and that's the way you want to monitor your business, that's fine. It's not like there's a right way and a wrong way as far as how you do your income statement. The only caveat to that, I would say, is you have to be careful that you've got the items in the right places, that you're not putting income items on your balance sheet, which we do see on occasion. And that just takes a little bit of practice to make sure you've got those accounts in the right financial statement category. But again, I bring it up because it's things like the cost of goods sold. And cost of goods sold are going to pertain to those of you that are in the retail business or that you're making something for resale, that it's how you group the expenses that are directly related to whatever it is that you're selling. So if you're selling a widget, it's that logic of what's the cost of that widget? What's the cost to produce it? And the reason I say that I don't want you getting too hung up on it is because everybody seems to have a different opinion on what those costs are. So you're going to get some that are going to be really obvious. You've got the actual raw goods that go into the widget. But then you're going to have other items that are what they might call the indirect expenses, which is your time and labor that's going into the production of that widget, your overhead associated with that widget being things like the space within the building that you're in. So you can get really hung up on all the different categories that pertain to cost of goods sold. But the bottom line is it still works its way in to the bottom line eventually. In other words, the grouping's not all that important other than the way you want to look at it. And I don't mean to over-elaborate on this, but I just find some people come to me and they'll say, well, does this go here and does this go there? And it's kind of, well, it depends on how you look at it. Because you'll find as you move forward with your business that the best analysis that you can do on your business as to how you're doing is a comparison to how you did the prior month, the prior year. It's very difficult to find another business that's exactly like yours. There's lots of publications out there. We subscribe to 2 or 3 of them. It's kind of nice to look at them, but to be honest with you, I find very few businesses that when I look at all of the industry averages, it really shows that they're right on track. And usually it's because their business is a little bit different. Every business seems to be a little bit different. So I guess I just don't want you to get too hung up on when you look at your financial statements and compare to others that yours look a little bit different. That's not the end of the world. All right. So moving on, how does my ending inventory value affect my gross profit, net profit? Again, for those of you that are going to have a retail business that have an inventory, this becomes a real critical factor. And inventory is probably the most complicated area for most small businesses to deal with. So that's why I tend to focus on it if it's going to be an issue for your business. I know there's a lot of you that aren't going to have inventory, so it's not all that pertinent, but again, what I would tell you is if you are going to have inventory, it's an area that you want to focus on. Generally, what small businesses do is that they adjust their inventory only periodically, meaning as you sell the item, you don't necessarily pull it out of your inventory. So you've got this mismatch as far as tracking what you've got on hand all the time. It directly affects what your income is. So you need to be careful that you're monitoring your inventory and recording it as sold as frequently as possible and reassessing your inventory as frequently as possible, because it does have that direct impact on what your income is. The distinction in part comes from the fact that while it's in inventory, it's an asset of yours. So it comes back to my comment before about balance sheet items. An inventory is an item that you can go through and count it up and total what the value is. So you can look at your balance sheet, and as of today, I've got $10,000 on my books that represents my inventory. You can count up all the different items that make it up. When those items are sold, they go over to your income statement as a cost of goods sold. That's that relationship between your balance sheet and your income statement. The effect then is every time you move it over to your income statement, it's reducing your income because you've got that added expense now that's gone over there. So as you reduce your inventory, you're reducing your income. If you don't do it fairly frequently, you have a misleading number on your income statement because there aren't the associated expenses for those items that have been sold. I'm hoping that kind of makes sense. This again fits in that category of it's important. I want you to be aware of it. I want you to focus on it if you're going to have inventory, but it's not going to do it justice for me to try and explain it in 5 minutes. I just wanted you to appreciate what the significance is going to be on your income statement and in a relationship inventory has with your balance sheet and the income statement. All right. So now we'll talk a little bit about accounting software. Which accounting software should I use? What features should I be looking for? This actually is a much more interesting topic, I think, in the sense that nowadays there's a lot more options that you have available to you. In the last probably 3 years or so, there's been a lot more software that's based on the web. So for example, well, first of all, I'm assuming most everyone has at least heard of QuickBooks. Is that a fair assessment? You can just nod heads. QuickBooks is by far the most prevalent software that we see. There's actually other programs that are out there. You might have heard of Xero or FreshBooks. For a little bit bigger business, you'll see Sage software, but there's a lot of different software programs that are out there. What most of them are doing now is they're based on the web. So you're seeing that more and more prevalent. The advantage to it being based on the web is basically it provides you with a constant backup. So all of your accounting records are perpetually backed up for you. And it gives you access to your records 24/7. Pretty much as long as you can get to a computer, access the internet, you can access your books. The other thing that's going on and has been occurring more and more the last few years is that all the banks now allow you to download information. So you'll effectively be able to download, if somebody made a deposit to your account, and in most cases you're going to be aware if you made a deposit to your account, but you'll be able to pull it down automatically from the bank. It will download right into your accounting software. It has simplified the accounting vehicle to a certain extent. I always find that when things get simplified, they actually get more complicated because it's a little bit easier to make a mistake that way, but still, that's the logic to it, that you'll be able to pull it in. Some of you may be doing something like that now. I don't know if any of you use a program like Quicken or Mint, where what it does is it actually downloads all of your personal activity out of your checking account and credit cards to keep track of what you're doing personally. It's the same idea. They've now expanded it to the business level. What I'll say though is a lot of those programs are very basic. Not that they're bad, and it really depends on what you're doing in your business, and it depends on whether you're comfortable working on the web. What we tell people is that if they have not worked with an accounting program before and they're comfortable with the idea of working with a program on the web, then something like QuickBooks Online or Xero are certainly good options for you to work with. Like I said, it gives you access 24/7. The other thing that I like about it is it gives me access to it 24/7 if I want to look at your books. If you want to call me and say you've got a question with your accounting records, something doesn't make sense to you, you can give me the login information and I can access it the same way you can. And I can view it at the same time you're viewing it. So we can address it in real time. In fact, while I'm on that topic, what we've been talking about a lot now within my practice is the idea that when it comes to the accounting world and the bookkeeping for small businesses, it really has become more of a real-time function. Our role used to, unfortunately, our role was always historical in the past. In other words, we'd have to wait until month end for you to give us the information for us to really review how your books were doing. So we're always looking at it probably 2 weeks into the following month after you've incurred or you've run across an issue that you had a question on. Nowadays, you can call me up and I can access it at the same time you're looking at it, so we can get it addressed immediately. And again, coming back to my comment a minute ago about having that available to pull down that information directly from the bank or the credit card company or wherever, it does make it so that you know exactly what's going on with your business. You know when that check cleared, for example. So it really has made it more of an instantaneous activity. Okay. Point of sale I'm going to let go for now because that really talks about more for retail, which is only a limited number of people. Salaries and benefits. This comes up because we get a lot of questions that are asked regarding independent contractors. I don't know how many of you at this point are really anticipating hiring any kind of, or working with any kind of independent contractors. The issue is if you hire someone as an employee, you've got to deal with all of the payroll-related issues, the withholdings, insurances, those kinds of things. Whereas as a subcontractor, you don't have to deal with those. So there's a lot of incentive to try and find people that will work with you as a subcontractor, and that tends to be the inclination of the way a lot of small businesses tend to operate. I won't go into a lot of detail on it, but basically what's going on is, as far as the state is concerned, and even the federal government to a certain extent, they're looking to make sure that you're treating these people as employees, at least if it's appropriate to treat them as such, because otherwise they miss out on some of their unemployment dollars, the Social Security taxes, those kinds of things.
This will also go for the people that said they were going to be providing services. You may be on the other end
Right,
and
good
receiving
point.
that.
Good point.
You get paid through a 1099 from whomever.
Yep. And the 1099, basically what that is, that's the reporting form. Instead of getting a W-2 then for whoever you work for, you'll get a 1099. And the 1099 is purely saying, here's how much you were paid. I think I'll leave it at that unless, I think what I'll do is I'll leave it at that with the idea that if people are anticipating either employees or that they're going to be working with independent contractors, that, you know, certainly ask the question later. Okay. Retirement plans, again, I'm not going to spend a lot of time on that now, but it does come up, and I want to mention it in part, not so much that I think you need to be concerned about what your retirement plan is going to be the day you start your business, but at the same time, what I would tell you is you should certainly consider it from the perspective of you want to run your business the same way you would want somebody else to do it, in the sense that if you're going to be an employee for another business, you want to know what your retirement plan options were. So I tend to emphasize the idea that you want to offer yourself, in essence, the same benefits that you'd be offered if you were an employee elsewhere. You need to set aside money for your retirement. Don't bank on the idea that the business is going to turn into the next dealer.com or whatever, so that you're going to make millions out of it in the future. You really want to treat yourself almost as if you're kind of the left hand and the right hand, in the sense you're both the employer and the employee, and look at it from that perspective. And there are quite a few different retirement plan options. And again, if any of you think you're ready to roll into those retirement plans, let me know, we can talk about it more. Along those lines, I've got comments regarding officers' health insurance, the life and disability insurance. First of all, as far as the health insurance is concerned, it is a deductible item for your taxes, so you do want to monitor it accordingly. It's the same as true as for any health insurance that you offer your employees. So that insurance is fine as far as being a fringe benefit. There are other and being a deductible fringe benefit for tax purposes. There are other fringe benefits that don't tend to be tax deductible for one reason or another, one of which tends to be things like life insurance. The logic with life insurance is that you don't deduct it and get a deduction for it or a tax benefit for it on the front end, because should your heirs ever need to collect on that life insurance, when it comes in, it would be non-taxable at that point. So you don't get a deduction on the front end, but you don't pick it up, the heirs don't pick it up as taxable on the back side either. The same holds true for disability insurance. In most cases, you don't deduct the disability insurance on the front end, so that if you should ever need to collect, you won't have to pay any taxes on it. And because of the way disability is determined, or the way they calculate what the benefit is going to be, it's actually a reduced amount already. So if you reduce it again for taxes, you're having a very small amount that you're going to be receiving for disability benefits. And in most cases, because of that, people end up underinsured for it. Again, we can circle back to that when we start talking about other fringe benefits, but it's just something that you want to keep in mind. Health club dues, I wish I could tell you it was deductible. Around here, the one that I see the most frequent is ski passes. You know, you would think it would be allowable because it's kind of a health-related thing too. Not only is it morale, but it's also good for health. In any case, that's non-deductible if you do it. It depends on, I guess, how you're paying it. But the issue is, if you're paying it on behalf of yourself or an employee, it is part of your income. So the business owner deducts it as an expense, but the employee is picking it up as part of their wages. All right, so it's not a tax-free benefit that you can offer to an employee. Financing, I talked about it a little bit already as far as what you're going to need when you go to talk to a banker. One of the things they're going to look for is a budget. They're going to look to see that you've got your books set up so that they balance and that you understand what you're doing with your accounting system. They're also going to look to see what you've got for personal financial statement, because in almost all cases you're going to be personally liable for any of the debts that you incur for the business. And again, because it's going to be from a personal perspective as well as from a business perspective, they are going to be asking you a lot of personal information about your finances.
Next month's round
Yeah, so I didn't want to spend,
is
right,
on that.
that's true. I don't want to spend a lot of time on it. Business plan, again, that's kind of the idea. That's your budget, really. And then the other topic I touch on a little bit is the line of credit. And I'm assuming you'll cover it more next month, but basically the line of credit idea is, that's more like most people, if you're going to compare it to what you do currently, it's very much like a credit card. The idea is you might run up the balance. The bank gives you an approval, for example, of a $25,000 line of credit. You run up the balance because you've incurred some expenses before you get paid for doing the services you've done. So you've got this mismatch going on, but you need to pay for your expenses up front, so you use your line of credit, you use your credit card, and then as soon as the money comes in, you use it to pay it back down. The theory behind the line of credit is a constantly fluctuating balance, as opposed to the other type of loan you'll get from the bank is what they call a term loan. So if you go out and you buy a piece of equipment, you'll pay that off over a 5-year period. So that's the term that you repay the loan. So that balance just works its way down gradually. And if you pay it off any quicker than the 5-year period, you don't have access to that money again. With the line of credit, you'll borrow against it. Again, using the $25,000 example, you borrow $15,000. money comes in, you're flush, you can now repay that loan. It goes back down to 0 when you repay it. A month later, you may need to borrow again, it goes up to $10,000. So again, the line of credit is pretty much what a lot of you, again, are probably familiar with as far as your own home equity lines, but that's the logic to it. And as I mentioned, I've kind of alluded to it, but a lot of small businesses do a lot of borrowing via personal credit cards and their personal residence, basically. We see a lot of home equity loans also. All right? So I think at this point, I'm going to...
Touch on the SE taxes.
You want me to do the SE taxes now? I'm going to come back to them after we went through the entity. But the issue with the SE taxes is that most of you are probably familiar how it works when you're an employee. You have withholdings taken out of your pay stub every week for you. A part of what's taken out for you is not only the income taxes, but you've also had the Social Security taxes withheld. The issue there then is that you have, for example, 7.65% taken out of each paycheck. Your employer is also paying in 7.65% for you. So combined, it's about a 15% Social Security tax that's being sent into the government on your behalf. So that's kind of nice, it's convenient, your employer takes care of all that for you. The issue that you're going to run into if you operate as a self-employed individual or as an unincorporated entity like a partnership, you end up with the income that flows through to you from those entities, whatever the net income is or whatever you draw out of the business, is going to have not only income taxes paid on it, but now you've got to pay the Social Security taxes on it. And as you can imagine, the federal government's looking at it as, hey, we're not going to let you get by with only paying 7.6%. You've got to pay both halves of it now. So as a self-employed individual, you end up paying 15% for your Social Security taxes.
That's where that capital equipment comes in nice.
Yeah, right, there you go.
Cut down what you
It cuts
earn.
down your income taxes as well as cuts down your Social Security taxes. It's referred to as SE taxes, self-employment taxes, as opposed to Social Security taxes or FICA the way it is on your pay stub. It also becomes an issue because since you don't have a pay stub and nobody's withholding it for you, you've got to make the payments yourself. So now, as a small business owner, you're forced into the position of paying what we call quarterly estimates. Some of you may have had to pay quarterly estimates in the past, but it's going to be a new thing for you once you become self-employed and you have earnings. And like I said, you need to factor in that 15% on it. And I could go on, but maybe I'll leave it at that.
I think that's a high enough level for now.
Okay, good.
All right. First question is, do I need a lawyer or can I do it myself? A lot of people ask this. Selfishly, I recommend hiring a lawyer. But really what you need to think about is this something that I can do on my own correctly the first time? And if I do it incorrectly, what will happen? There are programs out there like LegalZoom and other ones where you can go it on your own. But once again, you need to do it correctly. So the other area it comes up in is, are you comfortable that that contract you pulled off the internet, that it is enforceable in Vermont and actually says what you think it says? So those are things to keep in mind, which leads to the next question. What value does a lawyer bring to the life cycle of a business? Well, you're hiring a business advisor. A good business lawyer will work with your accountant, your retirement specialist, your insurance broker, to get you to the right place, to allow you to make an informed decision. The lawyer doesn't make the decision. They give you the information so that you can make the choice that's right for your company. It also, I think a big piece is you're buying peace of mind. This is what the lawyer does for their job, so you know that they'll do it correctly and you don't have to worry about it. You can focus on your business. It's hard to find a qualified lawyer. The same rules apply to finding an accountant. It's a business relationship. You should ask people who you work with. If you have a trusted accountant, likely they've worked with business lawyers in the past and they have some recommendations. The web is a good resource. If you look at somebody's website, it looks professional. You can see their background, their experience. That's a good starting point. What I do recommend is not just hiring the person who did your real estate loan closing. It's a different skill set. They may be good as a business lawyer, but likely they are focusing on the area of real estate law, which is a very complex area, but it's different. I don't focus on real estate law, I focus on business law, and there are a number of people who do the same way. So that's my 2 cents on hiring a lawyer. The next question that you really should think about is, how are you going to be charged for their services? Nobody wants a surprise when they hire a lawyer. Lawyers typically work in 2 methods. One is a flat fee basis. The advantage to that is going in how much they'll charge for something like forming a business. Flat fee type of work is typically done on more routine matters. Many lawyers will also charge on time and expense, meaning they have an hourly rate and expenses for filing fees you're responsible for as well. You'd want to ask what minute increments do they charge? Some lawyers they charge in 6-minute increments, but charge a minimum of 15 minutes every time they pick up the phone. That can be frustrating if you call for a question that takes 2 minutes, but you're going to be charged for 15. It's also something to keep in mind if you're on a time and expense basis, that if you're constantly calling a lawyer, you're going to be charged for that. If it's a flat fee basis, the lawyer, and I like to, for business formations in a fairly standard setting, I prefer to give a flat fee basis so I can address questions and people will feel comfortable calling with their questions, do not feel like their bill is going to be run up. You need to set the budget with the lawyer. Once again, you don't want a surprise. The lawyer doesn't want one and you don't want one. So you should have a pretty good sense of how much something is going to cost on the front end. Communication is the key. You should feel comfortable talking to your lawyer, emailing them, whatever you feel is the best way to communicate with them. What questions should you ask when selecting a lawyer? You should understand what their process is. Every time you hire a lawyer, it's for something different. Are they listening to what you're saying, or are they telling you what to do? You want someone who understands your business and is working with you and for you. I don't know everybody's business inside and out, but if I hear how you want to operate, where you want to go, I can lead you in the right direction. This is one I've never been asked, which I'm surprised, and you should ask it. Do you have malpractice insurance? Vermont lawyers, surprisingly, are not required to carry it. You hope that they're not going to make a mistake, but if they do, that's what the malpractice insurance is there. It's to protect you, so that if there's a claim to be paid out, there's money available. But it's just still very surprised. First question I get is, should I form a company? And if so, what are my options? I suggest that anybody who is operating a company or a business, that there's any potential liability that can't be covered by insurance, form a company. There are other reasons to form a company other than liability protection. It adds increased credibility to your business. It allows ease of transfer, which means that if you decide to sell your company, it's easier to sell it. It allows for control and shared ownership, where you can maintain control of a company but bring on co-owners. This often comes up in a situation where you bring your kids into the company. They want to be owners, but you still want to control the company. It also separates business records from personal records. That separation is a very good thing to have. There are certain common options. There are a whole number of different available types of entities. But I'm going to walk through the sole proprietorship, the partnership, briefly talk about a C corporation, an S corporation, and an LLC.
There is a sheet in the package that actually lists all
There's
these.
a grid that, a lot of what's in the grid I'll be going over. You do each for different reasons. So I'm just going to go in the order that they're listed in my notes, from the most basic to end up with the LLC. Sole proprietorship is the most basic. That's, you go out and you just start operating a business. It can be a trade name or it can just be a doing business that has advantage to that. It's very simple. The huge disadvantage is it's unlimited personal liability. It's hard to raise capital. It's not separating your business life from your professional life. So you need to protect yourself with insurance. Next option is a partnership. Partnership is when 2 or more people get together to operate a company. Typically, they're operating under a partnership agreement, which is a written agreement, but that's not required. This is another bad idea. I've yet to recommend one of these. The reason is it allows for unlimited personal liability, not only for yourself, but for all the liability in the company. So if your partner incurs a business liability they can't pay, you are personally liable. And if somebody is going after the company, it's not for them to decide who should pay. It's joint and several liability, meaning if you have more money than your partner, or it's just easier to get to, that's who I'm going after. So that's a major disadvantage. It has real advantages on the tax side, though, where a partnership is a flow-through entity, meaning it's not taxed. I'm going to give a real high-level view of this, but basically items of income loss, deductions, credit, they flow through to the individual partners, and the partners within the context of our tax code are able to use those items to offset income on their personal taxes. Like I said, they're the huge disadvantage of personal liability. The other one that's kind of interesting is, since it's a flow-through entity, if the partnership's generating income, but holding that money in the partnership to maybe reinvest and not paying it out to the partners, you still recognize that as income. So then you have a mismatch of earned income you're going to be taxed on without the distribution of money to pay it. That's usually an unpleasant surprise for some people when they get into that situation. Turning to C Corps, I'll be very quick on this. Almost nobody who is starting a company in Vermont is going to operate under a traditional C Corp status. It's your traditional company with either one shareholder to unlimited. That's where your Fortune 500 companies operate. They offer liability protection to shareholders. You're not responsible for other shareholder actions. It allows the company to raise capital through issuing shares or its own debt within a whole complex set of rules. The real disadvantage with it is the double layer of tax. The corporation is taxed on its income, and then when any income leaves the corporation, it is taxed, meaning if the company pays a dividend to a shareholder, the shareholder incurs a tax. If the shareholder is an employee, they're taxed on their income. So if you have one shareholder with a corporation, the corporation's being taxed, the shareholder who is the employee is being taxed, and if there's money pushed out on a dividend, they're taxed. So that's a real negative for most startup companies. Now we're going to go to the S Corp. We have to talk about it because it is a common form of operating a business. It's a small business corporation. It's actually a tax designation that you file with the IRS. And the advantage to this is it takes the best of both worlds. It has the liability protection of a C Corp and similar tax principles of a partnership. So you have, it's a flow-through entity. So it can be very tax advantageous on the self-employment tax side, which I'm not going to go into, but that's often why people are selecting it. The downside to this is there are restrictions. Although your grid says that you can have 75 shareholders, they changed that to 100. But that's not typically an issue. What is an issue is who can be a shareholder. You have to be a U.S. citizen or resident. Corporations and other types of entities aren't allowed to hold stock in these companies unless it's very special circumstances. and you can only have a single class of stock, which can be prohibitive on how you operate the company. And if you inadvertently trip these up, you can lose your S Corp status and be taxed as a C Corp, which means the double layer of tax. So if you have one of these, you really have to follow corporate formalities to make sure you really understand what's going on and work with your accountant and lawyer to keep you on the right track. Now, the last type of company is the limited liability company. That's the most common one I run into. People typically come into my office and say, I want to form an LLC. And we have to take a step back and really review why they are, what type of company they are going to form, what makes sense. A limited liability company, otherwise known as an LLC, is owned by its members. The default provision when you form an LLC is that it's taxed as a partnership if you have 2 or more people. If it's one person, for federal tax purposes, it's considered a disregarded entity, meaning that the IRS ignores it. It's completely a flow-through entity. In certain circumstances, you may decide, or your accountant may decide it makes sense to have it taxed as a corporation, and that's an election that they can make. Most people, when they form an LLC, want to have the flow-through tax treatment. The real advantage to an LLC is it's very flexible. You can have it so you have multiple owners who are treated differently as far as how income and loss allocations are made. There are complex rules to make sure that it's respected, but ultimately it gives you a lot of flexibility in how you can run a company. It is easier from a perspective of maintaining corporate formalities. You can also switch how it's taxed over time, so as your business evolves, you may make decisions to shift how it works. So now that you've selected an entity, I'm going to want to know probably how to form it. I'm going to assume that you made the right choice and hired a lawyer. Otherwise, you follow steps at LegalZoom. So you met with your lawyer, you discussed your business, you've selected a business. I'm going to assume it's an LLC. You have a sense of what the business is. The lawyer will put together the documents. Typical documents are operating agreement, articles of organization, formation consent, an application for tax identification numbers, your federal EIN number, your small business tax account. Usually the owners want an exemption for having to obtain workers' compensation insurance for themselves, so there's an application for that. So you have this whole raft of documents that you look over. Likely you'll have some questions, but once you have had your questions answered and agreed to the final format, the lawyer will file these documents with the Secretary of State's office, the Vermont Department of Labor, the IRS, and the Vermont Department of Taxes. If they're done correctly, they're approved. If they're not, they're rejected. That's where, if you're on a timeline, you want to make sure you have it correct. And that's where a value of a lawyer can come in who has done this before. When you get your approvals back, you have your formation meeting or consent, and in that consent, there are a whole raft of things that you're approving. So you might be opening a bank account, but basically you're approving all the actions that you took, or your lawyer, who's the incorporator, took to make sure your business is up and running. The last quick question is, can I change my entity after it's been formed? The answer is yes, but you definitely want to contact your accountant to make sure you're not going from one type of entity to another that will incur adverse tax consequences. It's easier to go from a partnership to a corporation versus the other direction. So we'll leave it at that. There may be reasons why you want to do that, but you want to go in with your eyes open. First question is, what liability protection will my business entity afford me? It's easiest to say what it doesn't do. It's not going to protect you against your personal wrongdoing operating your company. So if you negligently injure somebody, you fail to deposit employment taxes for your employees' wages, you commit fraud, you fail to treat the company as separate from you, you're not protected on that front. What it does help you protect you is from the business debts, unless there are personal guarantees. The idea is personal assets are being separated from the business and the liability generated by your co-owners. If you properly capitalize the company, courts will respect the form. Next one we talked about, you can get out of workers' comp. I like this one. My business is low risk. Do I need insurance? Yes. The unexpected can happen, and insurance can make the difference between a catastrophic event that causes you to go out of business to weathering of the event and being able to continue. What types of insurance to consider? This is where it's helpful to talk with a insurance broker who specializes in commercial insurance, not the personal lines. The typical kinds of insurance you'll find are professional liability insurance, which is often referred to E&O coverage. Basically, certain professions, you need to have that to cover your mistakes your negligence while failing to perform the type of work you're doing. Accountants, lawyers, doctors. It really depends on your industry, so if it's available, you probably shouldn't go bare on it. General liability insurance, that's covers third-party lawsuits over bodily injury or property damage. Commercial property, that's like your property insurance for your house, just for commercial property. If you have a home-based operation, this is an interesting thing. Your homeowner's insurance often will have exceptions that will prohibit coverage for home-based operations, and the issue that comes up is if your inventory is being stored in your garage and something happens to it, it may not be covered. So you want to talk to your insurance agent to find out what is and is not covered. If you have an actual location, so a brick and mortar, business interruption insurance is a very important insurance to consider. It's a type of commercial property insurance that covers loss of income when there's damage to the premises that prevents you from making or reduces your ability to make income. Think of having a fire. The landlord comes in and repairs the damage in a month. You're not allowed to break your lease because it was only 30 days, but you're not having access to it for 30 days. How will that impact your income? You know, cars, commercial auto, you should consider. If you have somebody delivering for you, their personal car insurance does not cover them. If it does, it's very unlikely it covers. So that is something to consider. If you have a website, you're selling products, collecting credit card information, personal data, cyber liability policies, they're inexpensive. They're still trying to figure out how to price them. But if you have to do credit monitoring for 100 people because you got a virus, that can be financially devastating. So you've got all these lines of coverages. Fortunately, often insurance, there's something called a business owner's policy that wraps these together, and it's often cheaper to buy it that way, where it takes common coverages for your type of industry and wraps it into one policy. The final one is if you are offering products you need for sale, manufacturing, or reselling. Product liability insurance is something you may want to consider. It protects you against personal injury and property damage caused by defects in your product. And then on the personal side, I would seriously consider disability insurance and potentially life insurance, particularly if you've opted out of workers' comp insurance.
I think you guys probably have some questions. There's a lot in all of these topics, obviously, and We were only planning to touch the surface so that you knew about what you want to go and find out more information about. But now is your time to get specific to things that you guys want. I think, why don't we do that? So I want to limit people to one question each because, you know, a lot of people may have questions. So anybody have a question?
You said if you're a limited liability corporation, you can change the way you get taxed. How often can you do that? Can I change my mind every
No,
year, or is this a one-time event?
depends which direction you're going. And typically people only want to change it one time. What will typically happen is you'll form a single member LLC, it will grow, you'll bring on people, the success will go up, and you say, I think it makes sense to change to be taxed as an S corporation. In order to do that, you would need to elect to be taxed first as a C corporation, and at the same time you elect to do that, you file the election to be taxed as an S corporation. Once you have made that election, I believe it's a 5-year period that you're not allowed to revoke it. There's also, and I have not run into a circumstance where people have intentionally blown the election by issuing a second set of, or a second class of stock. So it's not typical to change more than once.
I think the, along those lines, just to clarify too, the way the LLC works is, the LLC is kind of a legal umbrella, if you want to call it that, so that it's not uncommon, as Dave was alluding to, it's not uncommon to see an S corporation that's an LLC. So the way it works is, the LLC, again, is kind of from a legal perspective, I would guess, I'd say 9 out of 10, but it's probably more like 9 out of 100 businesses that we see come in as an LLC to start with. From there, there's the discussion of, well, how do you want to be taxed? And that's where we'll get into, in a lot of cases, they may start out as a sole proprietorship, again, like Dave was saying, and then they actually continue to migrate upward, so they become an S corporation as they grow. But they're still, that idea of an LLC is kind of the overarching entity for them. So the thing I always say is, somebody comes into me and they says, well, I'll ask them, how are they set up as an entity, and how are they being taxed? And a lot of times, instead of saying, well, I'm taxed as an S corporation or I'm taxed as a sole proprietorship, they'll say I'm an LLC. Well, from a tax perspective, that means nothing. Because you can be a sole proprietorship and be an LLC, you can be an S corporation and be an LLC, you can be a partnership and be an LLC. Well, I guess you'd be an LLP then, but in any case, you can be any type of entity. So you'll see some of these huge, large corporations that are listed as LLCs. And it's just the overarching type of entity, not how they're taxed.
Question back there?
Can you own multiple LLCs?
Yes.
Is there a limit?
No. You would want to look to why you would have multiple LLCs, and then how you would structure it. Is it something that you would have a holding company LLCs with a number of subsidiaries, or would they be independent? Some people will have multiple LLCs because they have completely separate lines of business. So I'm a lawyer and I'm a professional limited liability company, but an LLC. But if I owned my building, I would probably own it in an LLC that's completely separate from my, well, it would be separate from my law firm. So you have the two areas siloed.
Yeah. Well, in my case, with investment, real estate property, for each one, you would form a separate LLC.
That's
So
typical.
If someone sues,
Because you don't want to have a cascading effect if one of your properties has a major issue.
right,
Where the idea, if an LLC or any of these corporate entities is you siloed the risk into one entity, and in theory, anything that's in that is the maximum amount you could lose.
right. You mentioned that you can have an LLC above it, so that,
There are times that might make sense, but you'd have to look at your overall business structure to figure out what would make most sense.
Another question? Back there?
Yes, so, something that, you know, people who are looking to start a business, they're always worried about startup costs and whatnot, and trying to get all of these, you know, different pieces together. what can you expect in terms of startup costs, you know, getting the lawyer, getting the accountant and whatnot, just to start off?
Well, I think there's a second question to that. How can you, what are those startup costs, can you, is it the correct word, amortize over multiple years too? So,
No, it's true, you do get a tax deduction for your startup costs, and there are certain thresholds for it, but basically you get to write off in the year that you spend it. But your question is really more just from a cash flow perspective as far as what you can expect to pay. You know, it varies a little bit by business. I think, like Dave was saying, there's a lot of situations where you'll see it kind of as a packaged fee. A lot of times we do a similar idea to what he was alluding to, which is it's a package fee. You come in, we do these things for you, and part of it's a little bit predicated on if he does it or if I do it. And it's not so much as a difference in fee, but we just need to make sure that when you ask me what the fee is going to be to have us go through and get you set up initially, that I'm not quoting to do some of the same things that he's already quoted to do. So you want to make sure that your accountant and your attorney are talking, I guess, is part of what I'm getting at. But,
that's why we call them key partners.
yeah, yeah. And the other part of it, I know for us, is a lot of times we'll be doing a lot of the assistance in getting your book set up properly the first time. You know, make sure that they're right to start with, so we're not going back to recreate them the way they needed to have been to start with. So it really kind of depends on what all those pieces are. So I know it's kind of, I'm not specifically answering your question because it's a little bit of one of those that it depends.
I would call and talk to them.
Yeah, you always want to kind of go through and say,
Just ask.
what all do you need and that kind of thing. And most of the time, like for us, we'll say if you want just X and we're going to be doing the filings, this is what the fee's going to be, as opposed to, you know, if you have X, Y, and Z that you want, well then we kind of quote each one separately to give you an idea. But I think to come back to your question, part of what I would tell you is tell them exactly what you're looking for, so you have a good idea of exactly what you need and get them to give you a kind of a quote, a pretty solid quote on it. Because most of the time, I think it's safe to say it's kind of the same standard approach where it's not always true, and again, they did a good job of alluding to it, is you've got a partnership or you've got multiple owners, you've got to tie it up much more closely than you do if it's just you. Anytime you're dealing with somebody else, you're looking at, I think, almost probably a doubling of what it will take as far as the volume of your operating agreement, that kind of thing, just so you cover all those potential issues that you have with the second party.
And we didn't go through it, but the buy-sell agreement, that comes into play the second you have a partner. And that, I constantly am advising people, put it in place when you form the company. That's when the marriage is happy.
Also, don't assume. A lot of people go into something where it's family. Don't assume. Always work with your lawyer, get all the
But in a family
partnership
situation,
agreements.
it's typically the most difficult because you're not only dealing with the business, you're dealing with the family dynamic. But a buy-sell agreement deals with death, divorce, divestiture, a bunch of Ds, of retirement. Basically, how is your company, if something happens, going to address it? But that is something that wouldn't necessarily be part of your standard package. So it's one of those things when you call a lawyer or an accountant, they will tell you how much it costs, but they need the information of exactly what you're planning on doing.
Another question? I went back here first.
So I have an LLC as a sole proprietor, so I'm the only employee. But I'm not the expert in everything. So I was contemplating putting together like an unofficial board of directors or people that I want to, like if, hey, I want to launch a new product and I want to get feedback, but not go to the whole market, go to this kind of core team. Like, is that okay, or like, is that not okay and they're not like liable because they're not really employees or they're not part of the company?
If you're an LLC and you're operating as a sole proprietorship, you're not really an employee.
You're an owner.
Just to
Right,
make that
I'm the owner.
distinction. So
But I guess-
you'll be doing the SE tax, you don't have to do the quarterly estimates.
Because when I talked to my
Okay.
lawyer, if I went to a craft fair and I brought a friend, he
Yep.
was like, that's really bad, you shouldn't do that, because if anything were to happen,
The liability
Yeah.
exposure piece, yeah. To answer the first question you asked though, as far as having kind of advisors, there's nothing wrong with having them
Okay.
as independent contractors. You don't have to run them through payroll, that kind of thing.
You're not paying these people, correct?
Yes. Well, it depends, so like if I just want a bunch of people, so I make food, I just want them to sample it. And it's like, I don't know, if I did this research thing and I'm like paying them in food or what, that's I guess what I'm asking, like, do I have to pay them? Do I not, like, they're willing to do it for free?
Don't ask, don't tell.
Yeah.
It feels real good. I've had donations at the Red Cross.
I think it's a little bit of a distinction between from a liability issue, there might be
Okay.
some exposure from my perspective. It doesn't affect your taxes, doesn't affect your finances, that kind of thing, so if there's no payment to them, there's no issue.
And you had a question?
Yeah, so how would a business establish one or multiple lines of credit, and then what would be like a common example of that for a business?
It's a good question, because usually you don't see multiple lines of credit for a business. Generally, the idea is that that's, what you're gonna be using for the cycles in your business. So a lot of times you'll see the line of credit to reflect, just to use something like the ski industry, well, they're gonna be cash rich at the end of ski season, whereas as you get toward the fall, and the ski season hasn't quite started yet, which is why they promote all their deals for lift tickets, that's when they're tight on cash, that's when they're gonna use up their line of credit.
It's like assume they're gonna get that money, that's kind of
Right, so as soon as that money starts rolling in, now they can pay off that line of credit again. The theory to the line of credit, and I'll admit, it's not true for all businesses, but the theory to the line of credit is you run it up during the year, but at least at some point during the year, you paid it down to zero. Most line of credit agreements will say you need to have it down to zero for at least 30 days. So where I would, I guess, try to address your question is the idea that if you're gonna need a longer loan to get the business up and running, and you have to pay it off over a period of 5 years, you'll do that as a term loan, and then for those kind of fluctuations, you're gonna do the line of credit. And it just makes it easier on you in the sense that you're not burdened with trying to pay down a loan that you know you're not gonna pay down immediately. It's gonna have to be paid out over a 5-year period, for example.
So it's like short-term versus long-term, kind of.
It really is, and kind of what the purpose of the funds are too. So if you're doing something to get the business up and running, and obviously that's for a longer term, you wanna have a repayment that's gonna be more like 5 or 7 years.
All right, we have time for one more question. That was that alarm.
In accrual accounting, do you pay taxes on income you have reported but you haven't received yet?
That's a great question. I say that because for most businesses that we work with, once you get to a certain size, and depending on what the business you're in, it usually makes sense to maintain your internal books on the accrual basis. Because that way you really see how you're producing, how the bills are going out, how you're incurring your expenses, that kind of thing. On the other hand, for tax purposes, you can still file it on a cash basis, meaning you're not paying taxes on any of this money that you haven't actually had come in the door. So you get to have this nice mismatch to somewhat manipulate what you're paying for in taxes. The one caveat I'll throw out on that though is if you have inventory, for the most part, there are some exceptions, but for the most part, if you have inventory, you're supposed to be on the accrual basis. And that's because in order for you to have inventory, you almost always have to have payables. So it's kind of like you can't really have one without the other, which means you're kind of forced into an accrual basis. Probably more than what you wanted to know, but basically what I was getting at is, and if you're doing something that you really want to monitor when the money is earned or when the income is earned as opposed to when it actually comes in, it makes sense to try and do it on the accrual basis for your own records, but you can do it for tax purposes on the cash basis, so you're not paying taxes on anything before you actually received it.
So there's a lot of information we covered today. And the problem is these subjects are deep. All we could do is just touch the surface here. Lastly, bottom line is don't go it alone. You're out there trying to be successful in business. Get your accountant, get your lawyer, get your insurance agent, specializing in small business. Get your mentors to help you guide your way through it. Get the help to make you successful.